Right now it's time to welcome our next live guest. We've got Mike Bowden-Distel with us, our head of intermodal solutions here at FreightWaves. And Mike, we're talking a little bit about some Q2 results for domestic intermodal companies. Tell us a little bit about what's going on.
Companies will report their 2Q in middle of July, mid to late July, and was just talking to a financial institution last week about sort of what should we expect. Are there any sort of takeaways that we can look at from Sonar to give us give us sort of a preview of what to expect when they report their second quarter? And a couple of things that stand out to me is one of them was the intermodal contract rate data that we have in Sonar, which, those show the latest is up in the last week, up 19% relative to year ago levels. You see the blue line there is 2022. 2021 was in orange. And so, really up sharply on top of being up sharply. So 2 years in a row. And it shows the rates 44% above 2019 levels. And, for all we talk about coming truckload bloodbath and high inventory levels, which really are high in a lot of cases. Haven't seen that at least yet translate into lower intermodal contract rates. That's true of the dry van rates as well. Zach Strickland put out a good piece over the weekend on his chart of the week that showed those rates, those contract rates for dry van up similarly year over year. So it's been kind of amazing how much those have held up and how much those two data series have moved together, the dry van contract rates and the truckload contract rates. And so that's one important data point. The other important data point is domestic intermodal volume. Our data shows that up 4.5% in the second quarter to date through most of the second quarter. So and that's better than overall intermodal, which is down a little bit because if you include international piece, the international piece is dragging down the total average. So if you don't have that segmentation, you don't have the appreciation that JB Hunt, Hub Group, Schneider, their volumes are probably up year over year in the second quarter, as well as having the rates higher.
And Mike, what's one of the big reasons for contract rates still being elevated for intermodal right now?
Well, really, the intermodal rates tend to reflect what happened in the prior peak season. You think of the sort of the intermodal peak season as being sort of that fall. October is kind of the busiest month, and the contracts get renegotiated early in the year, and it just sort of follows what happened the previous peak season. And a lot of shippers, in order to have sort of the volume availability, the capacity available for the fall peak, they have to have certain volume commitments that throughout the full year. So it really sort of reflects tightness during last year's peak. So things could look completely differently if we have the same conversation a year from now. We could be talking about rates that were renegotiated lower.
And so, Mike, let's talk a little bit about some of these companies thinking like the JB Hunt, saying, you know what, we're going to add all this capacity back into the intermodal side of things. We're going to bring in all these containers by the end of this year. Can you talk a little bit about if that's a cause for concern or if that's going to help kind of smooth things out a little bit as we move through what's going to be, I'm sure, a really tight peak season in 2022?
It could be either one. If it's executed well, I think it could enhance the fluidity, because one of the issues has been not having enough containers in the right places. But if the network balance is done well, if it's executed well, if there are similar investments to terminals and they have the right sufficient crews, it could be a benefit.
And Mike, when we talk about the supply chain, we all know that it's all interconnected. So many different things have impacts on different parts of the supply chain. When you're looking at the intermodal side, are there any factors that are impacting this segment that a lot of people aren't thinking about right now? Or have there been any waves sent from international issues or domestic issues that could have really impacted this market right now?
Yeah, I think the big one is, the consumer. It really, because so much of what goes into intermodal is consumer goods, and some of it's, durable consumer goods like furniture, some of it's, non-durable goods, some of it's even, consumables, CPG products and those things. But, that's, I think, one of the big question marks going forward is, how much is the consumer going to retrench And really the big news story last week, I thought overall, was Jamie Dimon's comments, the CEO of JP Morgan, saying that the consumers maybe have 6 to 9 months before they really have to retrench. And they're still sort of leaning on the stimulus packages and those things and money saved during the pandemic. But that can only last so long. And, that'll impact intermodal volume. No question about that.
Michael, let's talk a little bit about what's going on with your newsletter and your show, The Stock Out. What are you writing about this week?
Really, right now, because companies aren't reporting earnings, talking a lot about, outlook for, the consumer. Just a lot of those issues that, could impact the CPG companies. And, there, I think you have a lot going on between the CPG companies maybe having a more contentious relationship with the retailers, where CPG companies are trying to push through price increases. They're getting pushback from the retailers. The retailers, maybe in some cases trying, different, having different, CPG companies, on their shelves. All the while they're trying to keep costs down to consumers that are maybe willing to accept a 4 or 5% increase, but not a 7 or 8, 9% increase, which is really what the CPG companies would need in order to, have margins that are stable. So, this current environment, I think, is really making things difficult for CPG companies' performance, but maybe even more so for the retailers, which people are going into retailers buying sort of things they need, but not having a lot left over for the other things, which tend to be higher margin.
And Mike, I want to finish out with a question following that. We talk a lot about the resiliency of the American consumer and the willingness to still continue to buy, put stuff on a credit card, even if they don't necessarily have the funds to support it. What about the resiliency of those CPG companies and of the retailers? At what point do they see a breaking point where they either have to take these massive margin hits and it leads to a destruction in their company overall, maybe bankruptcies, cutbacks, et cetera, or are they going to be able to sustain on these lean margins for just a little bit longer?
Well, the big CPG companies, the big retailers, they're strong enough to, weather the storm. The CPG companies last year took a lot of margin pressure, and it was really sort of putting the longer term interests of the company ahead of the short term interests. They were willing to share the pain with consumers and have price increases that were nowhere near what their costs were increasing, because they did not want to lose market share. So I think that the CPG companies, they want to continue to be in everyone's household. They don't want to lose share to private label, because once they do that, a lot of consumers won't come back. They'll realize private label is cheaper and just as good or close to as good. So I think those companies can weather the storm. Maybe there's some small retailers out there that won't, but the big ones that you really think of as being sort of the core ones that sell CPGs, I think those are in good shape. The retailers that you'd be more concerned about are the ones that sell things that you just really don't need. Certain things like home goods and things that are just completely discretionary.
Awesome, Mike. Well, looking forward to hearing the stock out later on today. I think I might even be a special guest. I'm looking forward to it, Kaylee.
Yeah. Talking econ.
Exactly.
Looking forward to it.
All right, Mike, thank you for that. We'll catch up with you later. Right now, we're going to head over to the wall. We've got our first carrier update of the morning.